Well, hi, everybody. Thanks for joining us for this event. I'm Rick Edelman and really excited to have you here on this special webinar, Living the Digital Life, the coming age of true portfolio personalization, and along with it, empowerment. This event is being sponsored by Franklin Templeton, and I'm really very excited to welcome Sandy Call onto the program with us. Hi, Sandy. How are you?
Hey, Rick. Great. Good to be here.
Sandy has been with Franklin for the past year. She came from Citi, and you can see her bio there. She is a technologist, really, with a very deep background in technological development. We have an awful lot of fun things to chat about. Sandy, everybody has heard, of course, of Franklin Templeton, and a lot of the folks watching use Franklin Templeton funds. But give us, some of the brief background for those who may not be as deep onto Franklin Templeton as they ought to be.
Great. Well, thank you, Rick. And Franklin Templeton is reinventing itself even as we speak, right? So Franklin Templeton has been around as an asset manager for 75 years this year. So it's our 75th anniversary. And we have always been really focused on delivering the best of active management to our constituents, both in the wealth business and in the institutional business. And we really believe in the power of active management and investment expertise. In recent years, we've really been expanding the Franklin family of brands and really moving out into the alternative space. We've added a number of alternatives players to our portfolio so that we can provide our clients a full array of different products. And we've been building out, and I think are the market leading asset manager in the world right now in terms of thinking about digital assets. And we have a lot of excitement and conviction about this space. So Franklin is really looking to provide the full range of investment opportunities to our clients and a full suite of investment expertise.
And, I really want to begin there because, I have a very long history, as you know, Sandy, with Franklin Templeton. And I was with Jenny Johnson earlier this week at another conference where the two of us were both speaking at. And Jenny said something really, really interesting. Jenny Johnson, for those that don't know, is the CEO of Franklin Templeton, been with the company for 30 plus years and, family owned hierarchy. And Jenny said something really, really interesting, that Franklin Templeton just finished a very elaborate series of studies on its own company, its own branding, and its own market positioning and such. And she said that in all the survey research and the focus groups and so on, the two words that popped up most often in their research among investors and clients, number one was trusted. And that's really important because that doesn't happen often on Wall Street. Number one, trusted. Number two, old-fashioned. And that doesn't totally surprise me. It didn't surprise Jenny at all, because Franklin Templeton is one of the oldest fund companies in America, as you just pointed out, 75 years and counting. And so while I don't think anybody who's familiar with Franklin Templeton, the mutual fund industry, the ETF world, would be surprised at those two words, trusted but old-fashioned. And yet, what most folks don't understand, and what Jenny has been really championing as a result of your recruitment to the firm, and I want to talk about your journey and why you chose to leave Citi and go to Franklin Templeton earlier this year, is that Jenny is really reinventing this company, recognizing that it is all about technology. It's all about automation and digitization, and that digital assets is a huge focus. Jenny is convinced that it's all about blockchain and digital assets, and she is redesigning the firm in a massive way. Most of it under the radar. Most people are really not yet familiar because Franklin Templeton hasn't made a big splash yet. You're beginning to lead that charge with the research you've been doing. And so talk about your conversations with Jenny and how she was able to persuade you to leave Citi and join Franklin Templeton.
Yeah, I mean, it's a little bit amazing how quickly Franklin has been changing and how quiet they've kept it. So I started talking with Jenny about this new digital asset space back in 2017, Rick, when I put out my
Sure.
first paper about the opportunities that tokenization represented. And Jenny has really, she has such a commitment. We talk about, you talk about technology being the driving force behind the firm. Jenny looks at it as technology driving the ability to give better portfolios to individuals. She has been absolutely scratching her head for ways to give individuals more exposure to different types of alternatives and to different types of asset classes. And when she started to understand the potential of blockchain and tokenization to really begin to create liquidity around less liquid assets, she got super excited. So we've been, in touch and talking about this space for pretty much on 5 full years now. And as we saw more and more traction within Franklin, and they really started to build out their capabilities, she really wanted someone to come in to really help build that story out to the marketplace. And that's what I do. I tell stories about the industry and how it's changing and evolving based on conversations I have with amazing, insightful people like yourself. And I talk to people all over the world and then go talk to all of the big asset management firms, the big hedge funds, the big private asset firms. And I was able to see that Jenny, unlike many of her peers, really thinks much more like a sovereign wealth fund. She thinks multi-generationally. She sees these technologies as enabling a new type of access to markets for individuals. And that means so much to her personally. And I think that's what's driving this is she sees the next iteration of Franklin delivering the same thing that it's delivered for the past 75 years, but using all the latest technology and all the latest opportunities to really make those portfolios even better for people.
It all starts at the top, and the direction of a firm is all based on the leadership of the CEO. And Jenny has really championed this, as you said, in a way that very few other financial service companies are doing. And she hasn't yet gone public with most of what's happening at Franklin. I've been privileged to have some deep conversations, not just with you, Sandy, but your colleagues in the firm, Roger and others. And I can just tell everybody that what is coming out of Franklin Templeton over the next year is going to blow people away. And you're providing a lot of core research in this field that I want us to dive into. In fact, you just recently wrote a 68-page paper on technology disruption. And in it, I just love the paper, and it's available, of course, at Franklin Templeton's website. We'll give everybody the link and let you all know how you can get a hold of that paper. But in it, you describe a tech-driven innovation cycle. You said automation was first, then digitization, and then virtualization, and now decentralization. And you call all of these mega trends that have stretched over the decades. We need to unpack all of these because people need to understand, sometimes, it's a tree and forest kind of thing. People are so immersed in the daily lives of the markets. We aren't often taking a step back to realize what's going on big picture around us. And we need to understand all of this because of the incredible implication for our practice management, portfolio management, client relationship, and so on. So let's start off with automation. Talk about that as the first of these innovation cycles.
Great. And thank you so much for giving us this time to really talk about it, Rick, because I do think this is an important paper because people lose sight of how much change we have already lived through in just our own lifetimes. And oftentimes it becomes, you hit a point where you're just like, no more change. I can't handle it anymore. But the truth is that we see opportunity in change. And that's why I wanted to start with this paper at Franklin, because we have been through, as you just pointed out, 3 tech-driven innovation cycles already. And a tech-driven innovation cycle to me is new technology comes out. It enables new capabilities in business and in enterprises. They have to re-architect their actual underlying technology delivery infrastructure to be able to take advantage of those new capabilities. And in so doing, they elevate new tech companies and they create new business companies that capture the value of that era. So you asked me to start with automation, and automation is so exciting because it was the first time that computers started to be used in a commercial business sense. Up until that time, computers had been limited almost exclusively to the military and to big institutional universities. And this was the first time we started to see computers move into the commercial realm. And the company that really led that charge was IBM. In fact, by the mid 1960s, one model of IBM computer actually accounted for more than half of all business computers in the world,
Wow.
right? So you saw this massive jump in businesses using computers and the peripherals around that, word processors, document management systems. And for the first time, we started to be able to automate a lot of the inventory and more management focused and manufacturing focused tasks that companies had to deal with at that time. Before that period of automation, it took 20 hours to program a single accounting program to run a day's inventory, right? And we went from taking 20 hours to program that to less than 3 minutes. So this is an incredible increase in productivity that we saw. And you saw, I think one of the epitomes of this period was the big Sabre airline reservation network. And they went from doing taking 90 minutes to do a reservation for an airline flight to doing over 7,000 reservations in an hour in this period. So you really saw this huge jump in the way that computers were able to bring tasks into the business day that allowed people to do much, much more, and productivity really soared as a result.
That's really kind of amazing. And most of us are too young to remember life before computers. But I remember growing up in the 60s and how computers were coming of age and starting to hear about them, and the photographs of a single computer occupying an entire room. And of course, then we went into the latter years where that computer then sat on a desk, and then it sat in your lap, and then you were able to hold it in the palm of your hand, and then it fit on your wrist. And so we're getting smaller, and we're getting faster, and we're getting cheaper as we develop this exponential growth of computer technology. But it all began with automation. And you look at so many industries, like back 150 years ago, 90% of workers worked on farms. Today, only 1% work on a farm. They went from farm to factory, and we had most people working in factories. Now we have a radical reduction of factory workers because of robotics and automation in the factory environment. We're now working in offices. And so this automation has been something we're kind of don't think about, because it's just, if I'm under the age of 70, it's just the way that it is. So it's just really fascinating. And by the way, we have just posted in the chat the link to the paper that Sandy has written, so you can download that and read that for free, and it's absolutely fascinating. So that was the automation megatrend, which has been around for 70 years plus. That led us to digitization, the next megatrend. Talk about what you mean by digitization.
So digitization really began with that first thing that you mentioned, Rick, the shift from computers occupying a floor of a building to an entire room and a floor to being on the desktop. And in the late 1970s, early 80s, we really saw this explosion in personal computing. And whereas I told you that IBM had accounted for more than half the computer sales in the world in the mid 1960s, by the late 1970s, they were losing market share rapidly to this new startup company called Apple that was coming out of the garages out in Silicon Valley. And so you had these personal computer wars in the early 1980s, and IBM changed their entire approach. They went from being a monolithic provider of end-to-end technology to creating their desktop technology in an open architecture manner. And they were one of the first big companies to go open architecture. And this really allowed them to thrive in a whole new iteration alongside all these emerging companies that really came out like Microsoft, Apple, Oracle. You saw a lot of new players coming, and right as they were gaining a lot of traction, the internet came along, right? And the internet really put tremendous pressure on businesses, because businesses now had to open up their processes to be available via websites. So systems that were designed to be used for just a few hours a day for a very limited number of users were suddenly being opened up to provide services to users 24 hours a day, and potentially hundreds of thousands of users that might be coming to a website. So as you noted, we had already been migrating workers out of the factory and into offices in this period. And this is what a lot of digitization did. It allowed us to start to allow all the individuals to use these desktop capabilities and this access of the internet to have a huge explosion in intellectual property. And we started creating more and more intellectual property, and the value that companies were deriving started to shift from tangible value to intangible value. We've seen an actual reversal of how much value in the models that people use to value companies, how much tangible value has decreased and intangible value has increased as we've gone through this whole period of innovation. So this was a huge change as well. And it really pushed us towards this services economy.
And so, in other words, a company used to be valued based on the physical plant, the inventory, the raw materials that it owned. Now it's being valued based on its brand, its marketing, its goodwill, and just the market share that it happens to have, which is not anything you can, put in a box or physically look at. And whereas we used to do our work in physicality, we would have our books and ledgers on physical pieces of paper that were filled out with a pen. Now it's just done with a keyboard and a screen, and it only exists in the digital world. And that data is being stored digitally, it's being transmitted digitally. And that is an entirely different world than what any of us grew up with. And so digitization has really changed everything. And of course, we're still now well on that path, all the way through to the digital asset world and NFTs. And we'll get into all that later on in this conversation today. But that digitization megatrend, which followed automation, was then supplanted by the next megatrend of virtualization. So explain what virtualization is for us.
Yeah, so one of the really interesting things about network technologies and computers is that you can actually run computers inside of computers themselves. This is called virtualization, and it's the way that you can split up the processing capacity inside a computer. And what we saw is with companies like Salesforce, people started to realize that they could actually let other people use their computing capabilities and offer them a service. And this was a really important transition because in the era of digitization, Rick, people had to keep rebuilding their infrastructures over and over. And you started getting lots of legacy systems that didn't talk to each other and lots of data.
I remember, Sandy, we would get the output from a fund company, like the statements from Franklin, and we would have to manually enter that data into our computer. And it was like, that was so insane, but that's what we did back in the 1990s.
That's right. And then what we started to do is we invented this idea of services. We started using APIs, application programming interfaces. And basically, these are like little wireless hooks that can go in and pull a function or pull data or pull an entire process out of someone else's computer, and you can use it in your own process and in your own environment. And then you had companies like Amazon create Amazon Web Services that took this concept and said, hey, you don't have to just use my API. I'll give you an entire processing platform that you can build your entire company on, and you can just rent it and use it for only the hours that you're actually on or using my processing capacity. So we started to see massive improvement in the way that companies use technology to run their businesses. It was cheaper, it was faster, It took less resources. It was more easy to adapt and change. And this was the foundation we needed to start to be able to see the rise of the next wave of really innovative companies, which were companies like Uber and Airbnb and Facebook and Twitter, all these companies that require massive amounts of processing capabilities and bring together massive numbers of people to be able to actually transact their business. This has only been possible because of this virtualization and this improvement in the way that we can access and use technology.
And if that wasn't enough, we're not done yet. So that you've brought us up pretty much to today, but what's coming next is what you call decentralization. So talk about what that is and what that means for us.
Yeah, so this one was super fascinating. When I learned about it, I always ask people in the digital asset space, what was your moment like when you realized like, oh my gosh, this could change everything? And when I started learning about decentralization was when I had my moment. Because just like I said in the beginning, we had computers, but computers were only being used by the military and by very, very large universities. And there was another technology as well that was only being used by the military all the way up until the mid-1970s, and that was cryptographic technologies, the ability to encrypt data and send it over networks securely and unencrypt data at its intended destination. And it wasn't until literally the early 1980s that we started to be able to use any encryption algorithms in the public domain. And we started to see a huge explosion and a huge conflict over how much security and how much encryption should people enable. And there were these crypto wars in the 1990s that was between the US government that wanted to allow encryption technology, but the government wanted to hold the keys to everyone's encryption so that they could monitor anyone at any time, and advocates of privacy that wanted those keys to remain private. And it went all the way up to a district court case, and they actually ruled that the right to encryption is a First Amendment right. And that really set the stage for us to start to combine network technology and encryption. And when we think about what that means is today we wouldn't be able to do online bill pay. We wouldn't be able to share medical records. All these things that we take for granted today are only possible because we fought these wars around encryption, and we were able to keep encryption private. And there was a group of people called the cypherpunks that were actually, they sound kind of crazy, but they were actually a lot of university professors and computer scientists who felt like that still didn't do enough to protect privacy. And they wanted more and better technology for people to be able to engage without companies taking all their data and potentially using their data in harmful ways. And this was the origin of all of the technologies that have come together in the crypto domain. It's the origin of the technologies for blockchain and Bitcoin, right? These all came from people that are believed to be part of this cypherpunk movement. And it inspired people like Vitalik Buterin to then take what was coming out with blockchain and Bitcoin and proof of work and all of these cryptographically protected transactional networks and take it one step further and really create a software development platform that will allow people to actually develop applications and engage in an entirely new ecosystem, but do it in a pseudo-anonymous manner where they can actually control what data is shared and be able to pull back and control their own data. So it's been a very interesting development because we're basically taking the tools of technology and taking the abilities it gives to individuals, and we're using those to create a new type of economic ecosystem that is a peer-to-peer economic ecosystem.
Now, the word decentralization might sound new to a lot of people, not terribly familiar with the usage of that word. And I can, intellectually, break it down, and I think I can get it of what we mean by decentralization. But what a lot of folks, Sandy, don't realize as they're listening to you, and this is all fascinating, by the way, is that decentralization, another term for that, or another explanation of it, or example of it, is blockchain technology and the alternative phraseology of blockchain, which is DLT, distributed ledger technology. So when you say decentralized, another word for that is distributed. Instead of having, for example, a single bank, a single controlling entity, having all of your banking info, and only they control it. They determine whether they let you have a bank account. They determine the hours at which you can conduct business with them. They determine the fees that they're going to charge you and all the other parameters. They are in control as a centralized entity. Now we have, through blockchain technology and the decentralized, the distributed data warehousing, there is no central authority in such control. So you're really talking about blockchain, digital assets, distributed technology. And that's what people need to get their heads around, is that, oh, this is the next iterative step toward technological innovation and development.
That's right. And just like when we went through the digitization age and we saw companies all of a sudden having to open up their systems via websites to all these users, this is the next step in that as well, Rick, because now we're not just accessing some other company's at wet systems to use their processes. The processes themselves are being built in the cloud for us to use whenever we want to, and no one owns them. Only the people who participate in the networks and earn the right to own part of the networks or buy into the networks own them. There's not a central entity sitting at the middle of this, as you very well explained.
All right, so now let's take this out of the academics and concepts and bring it down, because everybody here watching us is a financial advisor who is terribly concerned about client relationship, client management, client services. What does it mean for us? What does this decentralization mean? How is this changing society? How is it changing the world of investing?
So let's start with a few easy ones, right? And then we can get to a little harder ones, because it's changing it in a lot of ways. So I think one of the most important ways this is going to change society is that the number and the variety of assets that you as a wealth advisor are going to be able to put into a client's portfolio is going to increase massively, right? One of the issues we have in making different types of assets eligible for portfolios is it's hard to administer them, right? If you think about something like a royalty pool for your favorite singer, right? They might be willing to share part of their royalty pool, but how in the world are you going to put that into a portfolio for millions of people? It's just very difficult to do. So one of the first ways it's going to change investing is that a contract, a smart contract, is actually embedded in a token when you create a digital asset. And you can administer those royalty rights or any type of copyright benefits or any type of property benefits through clauses or covenants in the smart contract. So you and I can buy into our favorite singer's royalty pool. And even if we're only owning one fraction of a percent, that could still get automatically deposited to us each month when that royalty check goes out, because the smart contract is going to be doing all the work. You don't need people going out and tracking down all the owners and tracking down their account numbers and manually authorizing payment transfers. This is all happening automatically through the smart contract in the asset.
Now, a couple of things I want to make sure we emphasize here. That sounds fascinating and really cool. I would love to make money every time Born to Run plays on Spotify, being a big Springsteen fan. This is not theoretical. This is already beginning to happen. Bruce Springsteen, Bob Dylan, Stevie Nicks, Sting, Phil Collins, Pink Floyd, the list goes on and on and on, of recording artists who have sold their music catalogs to major corporations, private equity firms, and others who are going to do exactly what you're describing. They're going to digitize, monetize, and democratize all of this IP, because that's all it really is. It's just ownership of an asset. And they're going to tokenize all of it, just as we've tokenized IBM. We call it shares. We're going to take a $100 billion company. We're going to sell shares at $100 a piece. That's IBM. Well, we're going to take Bruce Springsteen's $500 million song catalog, and we're going to splice it into 500 million pieces of $1 each, call them tokens, and we're going to sell the tokens so that we get a 1/500 millionth share of the royalty. And this becomes a security. And this becomes something I can easily add into my portfolio, because we're taking an asset that was centralized. Bruce owned it. We're now decentralizing it, making it available to everybody, making it an illiquid asset liquid, making an expensive asset affordable. And all of a sudden, everybody everywhere can invest in Bruce Springsteen's music catalog. And this creates an asset class, music royalty rights, that never existed before.
That's right.
So that's just one tiny example. Give us other examples, Sandy, of assets and asset classes that will begin to be developed that never existed before.
So there's going to be so many, right? I've been talking to people that are launching really interesting ventures where they're going to be getting the curator of the Modern Museum of Art to put together a portfolio of the top digital artists in the world, and you can get access to a portfolio of non-fungible tokens held that is curated by the top art exhibitor and curator in the world. We're hearing about next year is going to be the 50th year of hip hop. We're hearing about people looking to put together a portfolio of the top hip hop music, and they're bringing in other rights along with it, because the contract can do even more than just give you rights to the royalties. It can also give you utilization rights, right? So I can, using your Bruce Springsteen example, I can go, not only can I own 1/500 millionth of Bruce Springsteen's catalog, but when Bruce Springsteen plays in my town as an owner of one of his music catalog tokens, I can get access to special seating at the Bruce Springsteen concert, where only owners of his tokens get seating. So you can convey utilization rights as well. So
I'll give you a great example of that, which you well know, the Aspen coin. A couple of years ago, the St. Regis Hotel in Aspen tokenized itself, and they sold shares of the hotel as tokens. And you not only now are an owner in the hotel, but when you go there and you book a room, you get an automatic room upgrade.
That's right. And so that's awesome for everything consumer related, right? I can go to my favorite clothing brands and buy tokens that give me special rights and access, and maybe special collections that only token holders get to have. I can go to my favorite vineyards. I can go, really anything you can think about that consumers use can be tokenized, and these rights can be given.
You haven't even mentioned sports.
Right. Well, and that's what I was going to say, but there's also ways to do this that can give you a different relationship with the people that you admire. So in sports, there's a really interesting play going on now in DraftKings and the NFL Players Association, where you can buy NFTs of your favorite players, and you can rent those NFTs to use them in your fantasy football league. And you can actually play your fantasy football league with these NFTs and get part of the pool that's available to people that have the NFTs. So you can start to use these assets as collateral, right? You can own a great player's NFT and you can rent it to people who want to borrow it for the season to play their fantasy football league. So it becomes collateral you own, which is also just a huge change in how we think about assets and the usability of the assets we hold in our portfolios.
And the word collateral makes me think of borrowing and lending.
Yes, exactly. And we can borrow and lend securities if you're at a qualified level, but now think about being able to borrow and lend anything in your portfolio, including these really personal assets.
So the bottom line is we can digitize and now tokenize any asset, any physical asset. So we're doing this already with artwork. You mentioned how we're going to do this in museums. Just this month in New York City, the Museum of Modern Art announced that they're selling $70 million worth of their Picassos and Renoirs and Rodins, and they're taking the money and buying NFTs.
Yep.
So they're converting their own art collection from physical art to digital art. And they said, look, we only get 3 million visitors a year to the museum, but our website gets 35 million visitors. So we need to give people digital art instead of physical art. So this is already well underway. We're tokenizing rare cars and exotic wine, and the list goes on and on and on. Bottom line is, to the point you made earlier, Sandy, advisors currently have access to 15 or 20 major asset classes. Stocks, bonds, government securities, oil and gas, gold. We're going to go from 15 to 20 asset classes to 15 to 20,000 asset classes. The opportunity for portfolio personalization is absolutely astonishing, which is why that's the title of this webinar, because advisors need to realize what's coming, and it's coming extraordinarily fast. So this is going to change society. It's going to change investing. It's going to democratize and demonetize the availability of assets. You're not going to have to be a sovereign wealth fund or an institutional investor, an endowment or pension fund. This will be available to everybody everywhere. But what are some of the unexpected implications of all of these megatrends?
So I think the first one is, think about how complicated this becomes, right? You just said it. Like, if I'm going from 15 to 20 assets to potentially 20,000 assets, how am I as an individual ever going to be able to manage that? And even the advisors on our call, I'm sure a lot of them are starting to think like, wait, well, how am I going to manage all of that? And this is where artificial intelligence and technology, again, creates such a powerful pathway for us. Because what was going to happen is just like what we're seeing with direct indexing today, is that I'm going to be able, as an advisor, to use a personalization algorithm that is going to allow me to collect just a few key data points on my client and use those data points in conjunction with smart engines that are driven by artificial intelligence to create dynamic portfolios for them based on their likes, their wants, their desires, their goals. And I'm going to be able to track all of the benefits that they are getting from the portfolio, from their risk-adjusted returns to their third-row tickets at the Bruce Springsteen concert. And I'm going to be able to tie those back to what I, as an advisor, have put into their portfolio. So I think one of the real impacts of this change is that the need for advice and the need for someone to be looking at your portfolio 24/7 is going to go way up, and you're going to need to rely, advisors are going to need to rely more and more on machines to be their partners to really handle that effectively.
And I would take it, I agree with you, and I would take it a step further. It will also mean that fund companies are going to become extraordinarily important, more than ever. I mean, advisors have already long done this. I've done it throughout my entire career. We've delegated the portfolio management to the fund companies because that's how those fund managers spend their 10 hours a day at work, so that I can focus my 10 hours a day dealing with my client. And now we're going to be more and more reliant on those fund managers and fund companies to package those products, because there's going to be such a massive array of tens of thousands of categories and literally millions of individual asset opportunities. I'm going to need help from somebody saying, here's the category that you need to be focusing on. Here are the assets within the category that we need to be including. Here's the asset mix and so on. And the fund companies that are championing this, that see it coming, that are developing all of this now, are going to be the ones well positioned to, I'll say, bail you out, to enable you as an advisor to remain cutting edge so that you can deliver this to a client. And that's why, I get chills when I listen to Jenny talking about what Franklin Templeton is developing. You're providing the empirical research that's allowing Roger and his team build the products that they can bring to market. And in fact, Franklin Templeton's already doing this. You've already just announced in the last couple of weeks a strategic alliance with Eaglebrook Advisors, a crypto SMA provider, a separately managed account provider, where you're already providing some of these funds, allowing advisors to customize the portfolios of a crypto nature on behalf of their clients. Franklin's already doing this. And I think you're the first to be doing it in the fund industry. I haven't seen anybody else doing this. And so it's really exciting. You know, the notion that Franklin is trusted matters, but that old-fashioned thing is going to be thrown away really fast as people begin to realize, as they're looking for a partner they can turn to, it's going to be Franklin Templeton. So it's really kind of amazing what's coming down the pike.
Yeah, and I'll tell you another really fascinating, unexpected impact of all of this, Rick, is that to hold these assets, right, I'm going to hold them in a wallet. Right? A wallet is a new piece of financial, I think, infrastructure that we're going to all have within the next 5 to 10 years. We're going to all have our wallets, and we're going to be holding our digital assets in our wallets. By then, I fully expect they're going to be tokenizing our equities and tokenizing our bonds because of the efficiencies to be gained through putting them onto blockchain. So I'll be holding my digital assets in my wallet. I'll be holding my equities in my wallet. I'll be holding my bonds in my wallet. And I will also be holding all of my operating cash, because my cash is going to become digitized. We already see the Fed talking about a digital dollar. We have China experimenting with a digital yuan. We have people talking about digital euro. And I am going to therefore combine, for an advisor, this is so exciting because it's going to combine a client's operating cash with their investment portfolio. And that cash, that pool of cash, becomes an asset that you can often and also optimize and find yield on. So I think this combination of the operating and investment account is also going to be a very fascinating opportunity for wealth advisors in the next few years.
So let's make sure the people will understand and recognize what we're talking about here. Mutual funds were overtaken over the last 25 years, 30 years by ETFs. ETFs are going to fall to the side to NFTs, non-fungible tokens, and tokenization. This is what's coming. How quickly?
Well, I think that the first part we were talking about, the new digital assets that require the smart contract to operate, the music rights, the wine, the sports rights, right? Those things I think will be coming within the next 2 to 3 years. I think that you will start to see more digital currencies and Fed experiments with the digital dollar within the next 3 to 5 years. And I think you will start to see wholesale migration of mutual funds and ETFs into tokenized wrappers that sit in digital wallets, not in investment accounts. I think that is definitely on track for within the next 5 to 10 years.
So I'm physically taking a step back here. We all need to recognize not just what's coming. You know, I think we can all agree that self-flying cars are in our future. You know, George Jetson is one day in our future. That's not the issue. The issue is the speed with which the future is arriving. Over the next few years, we're going to be tokenizing, digitizing, and creating online wallets on a decentralized basis for tens of thousands of new asset classes. Totally new and different way we will be delivering value to our client. So advisors who are having their heads in the sand, who are being dismissive of this, frankly saying, oh, Bitcoin's a fad or a fraud. I mean, if you don't like change, you're going to hate obsolescence. And so it's really just quite astonishing what is coming and how fast, and why it's so vital that advisors get the knowledge and education you need to remain current and of value and service to your clients. There's just no substitute for it. And so along that point, Sandy, what should advisors do to add utility to their services? How will this change the way they engage with their clients?
So I think the first and most important thing to do is what they're doing on this call today, is get educated, right? Learn about this new space. People who started learning about the internet in the early 1990s didn't know exactly what the internet was going to turn into, but they had to learn about it. People who learned about streaming services and platforms in the early 2000s didn't know where it might lead, but they had to learn about it. So the first thing you need to do, you're already doing. I would say the next thing is start to expand and help to educate your clients. This whole idea of Bitcoin is a fraud, or Bitcoin this or Bitcoin that. Look, Bitcoin was very innovative and very novel, and it will always have a place in history because of that. But if you think that the digital asset space is just about Bitcoin, you're really missing the story. So learn the bigger story. Learn about what layer one development platforms are. Learn about how you are able to use smart contracts to automate a lot of processes that today slow things down and keep things from happening quickly. Just like when we started talking about automation and we talked about how much improvement there was and how quickly people could process a airline reservation, or how quickly people could run an inventory report. We're going to see that same kind of jump and that same leap forward in our ability to create and administer rights through contracts within the next 5 years, right? It's going to be something we look back at in 5 years ago and from now and go like, wow, how come I never really saw that coming, right? But we can see it coming.
And are going to be best positioned to capitalize on it and build their business based on it. We're getting a lot of questions, as you might expect, from the advisors who are listening to this and with fascination. And here's one, we're going to take it out of the clouds and bring it down to about as tangible as you get. In an environment like this, where you have such amazingly diversified portfolios and such customization and personalization, how do you measure performance?
That's a great question. And I think it's a really important question because we in the industry sometimes get very caught up in thinking about performance is what we think performance is. Performance is some measure relative to a benchmark that we've created, the benchmark, and we've created that as a measure. And we try and convince clients that we're doing very well because we're able to get higher than this benchmark that we created. And sometimes clients really don't understand that and don't appreciate that. I think that the way you should talk about performance in this space is what matters to you as an investor. Is your portfolio giving you the cash you need it to give you? Is it giving you, as you get into these digital assets, access to assets that are interesting to you and that give you more enjoyment in your life? Are you getting a ability to have your assets deliver things like tax optimization and deliver any kind of ESG type value that matters to you? Or if it doesn't matter to you, to make sure that it's not delivering any of those return streams, right? You need to understand your customer and what's important to the customer and really make sure that the assets in the portfolio and what they are delivering is understood by the client. And that's going to be even more important once all of these utilization and administration rights come into play, because each asset might be contributing something very unique to that client, and it becomes a dialogue. It doesn't become a number.
So in the conversation of all this, and again, another logistic question that an advisor watching this has asked is, where does custody fit in? At the moment, we pay a lot of attention to custody. We rely heavily on our key platforms. The advisors who work with wirehouses, heavily dependent, of course, on their firms to provide custody. But if I've got all of my tokens in a digital wallet on my phone, what does all this mean for custody? First of all, do all these custodians go out of business as unnecessary?
Well, there's going to be two different kinds of custody. And I think this is really important to understand, right? We think of custody as holding the physical asset, right? And that's because we have grown up in a world where there are securities and we have security bookkeeping ledgers, but there is still a certificate underlying those ledgers, right?
A physical piece of paper, that stock certificate.
A physical piece of paper, and someone actually has custody of that physical piece of paper. So you've got to kind of put that concept of custody to the side, because your asset is digital and your asset sits in your wallet, and what gets custodied isn't your asset. What gets custodied is the key to your wallet. Remember, I talked a lot about how cryptography is so important to where the world is heading. That key is a cryptographic key. And what is happening, Rick, is that that key is getting split up into multiple parts, and each part is being placed in a different custody account that needs to come together to unlock your wallet. So what gets held in custody is the keys to your wallet so that no one else can get access to your keys. Think of custody in this case as more like a safe deposit box as opposed to an account.
So is this an existential threat for custodians?
I think that, it will still probably take us 20 to 30 years to see all the equities and bonds and munis and everything else, fully migrate into digital assets. So they probably have a bit of a runway, and you are seeing them really, some of the more leading custodians are looking at the digital asset space. So I think that they will adapt, but I think that, you also have to understand, what kind of custody are you being given? If you're on Coinbase and you're only trading on Coinbase, Coinbase also is custodying your keys, right? That's a little bit risky, right? Whereas if you're going to, this is one of the reasons that we built this Benji app at Franklin First, because we wanted a wallet system where they could keep the assets in a wallet that's not part of an exchange, right? So I think that you're going to see advancements in the space. You're going to see people need to designate a digital custodian, but I want people to understand that what you are designating is the keys to your wallet, and you can keep that wallet in a centralized location, or you can keep your wallet individually. There will be wallet providers, but that's your new piece of financial infrastructure.
And we've only got a few minutes left, and we have to end this conversation with the word that we haven't used yet, because it's clearly raising questions from the advisors who are watching this: regulators. Where are the regulators in all this? What's their attitude? How will they regulate? How will they protect investors if we're all dealing with our own digital wallets on our phones and so on and so on?
So I think the good news here is that the regulators are very, very engaged, right? The regulators are actively trying to educate themselves. We have worked extensively at Franklin Templeton hand in hand with the regulators to develop the products and to develop the infrastructure and the processes that we're putting together. And we're encouraging them to look at the problems that we've solved as a good template to think about how to create rules that work within a regulated entity. Franklin Templeton is 75 years old. We're a very well-regulated entity, and we're very proud of that. And we want to work within regulated rules. So first off, the regulators are finding the right partners who understand the opportunities in this space, but also the safeguards that need to be put in place. The second thing is to look internationally. The US is well behind on crypto regulation compared to regulators elsewhere in the world. Regulators in Asia, regulators in the Middle East, regulators in Europe are all much more engaged. They can already be registering crypto exchanges, registering digital assets. So there's models to be taken, I think, from elsewhere around the world that the US can adapt as well. But I think the most important thing is that regulation is good. We want regulation. And I think that when the regulators finally clarify the rules, that's going to be an accelerant, not a limitation on the growth in this space.
Yeah, I think you said the key thing there, that is the US regulators really don't have a choice, because this is a global technology. It's a global asset, trades 24/7, 365. And if the US says no, it'll just chase everybody offshore and around the world. And if we're going to maintain our economic dominance, if the dollar is going to remain its positioning as the world reserve currency, you can't say no. You can't ignore this. It's vitally important for our own national security as well as our economic foundation that we figure out how to say yes. And all the regulators worldwide are heavily working on this, and it's inevitable that we will get that figured out. Sandy Cole, the SVP of Digital Assets at Franklin Templeton, this has been an absolutely fascinating conversation. I strongly encourage you to talk to Franklin Templeton about the work that they're doing and the funds that they're already offering in this space, because I think you'll discover that there's a huge opportunity for you and your clients to stay cutting edge and build the portfolios of the future. Sandy, thank you so much for joining us. This was really a fascinating conversation.
Thank you so much, Rick. It was a pleasure to be here.
I'm very happy to tell you as well that we have more seminars, webinars coming up on November 7th, our next virtual event, investing in the global crypto industry via the picks and shovels route, not buying Bitcoin, not buying Ethereum, instead investing in the companies that are building this technology. I'll be joined by Global X professionals and experts talking about the new global crypto industry. That's November 7th, 2 to 3 p.m. And if you really want to learn more about this, get your arms around it and be able to demonstrate to your clients that you have developed proficiency in this subject, you need to get your certificate in blockchain and digital assets, an online self-study program, 13 CE credits, highly popular course that we've created a couple of years ago. We're fully updating it all right now. You'll learn about the technology, what is Bitcoin, what is blockchain, and the practice management, the investment thesis, investment opportunities, regulation, taxation, compliance, and most importantly, how to communicate with your clients about this. Register right now at dacfp.com for your certificate in blockchain and digital assets. You can binge it in a weekend or take your time studying it. And be sure to read my new #1 Amazon bestseller, The Truth About Crypto, which was just nominated by the Society of Business Writers as the best business book of the year. So pick up your copy of The Truth About Crypto. Sandy Call, thank you so much for being with us here today on the program. Thank you as well for joining us today. I'm Rick Edelman. I'll see you next time as we continue our webinar series, getting you the content you need about digital assets. Have a great day.